Welcome to the Fast Five by Fear and Greed. I'm Michael Thompson, and good morning, Sean Aylmer.
Morning, Michael.
Today, in just 5 minutes, it's all about investing in retailers. Sean, it's been a bit of a mixed bag for retailers over the last 12 months. Some went pretty well during lockdowns, depending on what they were selling and whether they had a good online presence, but others that rely on foot traffic really struggled.
Yes, and of course, they're some of the best-known companies on the bourse. Roger Montgomery is the founder and chief investment officer of Montgomery Investment Management. Roger, morning.
G'day, Michael. G'day, Sean. Good to be with you both.
What's the outlook for retailers now that we're through the Christmas rush and into 2022?
Yeah, we've been speaking to lots of retailers. We've been on a lot of their trading update calls and listened to what they've got to say. One of the things that's come through pretty strongly is that initial pulse out of lockdown, that initial surge of sales that retailers see, particularly as stores reopen, has been sustained. And in fact, where states haven't been locked down, they're all running at an average of about 3 to 5% above their sales levels prior to the pandemic. So it's going pretty well. Their gross margins are also higher, and that's because there hasn't been a lot of deep discounting or deep promotional activity. So generally, it's a pretty robust environment. And while some of the companies, I guess, had some stock challenges because, it's obviously pretty tough with the supply chain being impacted all around the world. It's hard to get stock. But a lot of our Australian retailers were actually carrying more stock in anticipation of that. And so they've done pretty well.
Okay, so as we head into the rest of the year and the likelihood that at least some interest rates will rise, maybe fixed rates might rise, and then into next year, potentially short-term interest rates. Are there any particular companies that you think will be affected for better or worse by that, ones that you're looking at closely?
There are a bunch that we've looked at and that we own in our funds. Probably the largest position we have is a company called City Chic. The reason why we own, I should say that we want to own businesses that are rolling out stores rapidly. If you're not buying stores that are rolling out a significant footprint, really what you're doing is you're owning businesses based on the macroeconomic picture. In other words, you're really just hoping that the economy goes well and doesn't go badly. And we're just not smart enough to be able to predict that. We don't know. So we'd rather go into businesses that are rolling out lots of stores. So City Chic is one of them. The other one, that the second biggest position in our small companies fund, is actually Accent. They're a domestic-only store, unlike City Chic, which is rolling out stores globally. Their stock was sold down. They became very, very cheap, we thought. And they were sold down partly because they're a store-based offering. They didn't have a super strong online presence. And so they were sold down on that basis. They also had a lot of stock. And again, that was a negative. But what's actually happened is that their new store rollouts, they've got Glue stores and they've got Style Runner. There are a couple of brands that they're going to roll out significantly. They've also got the Doc Martens brand, the Vans brand, and the Skechers brand. And so while they did take a hit from lockdowns, this store rollout story is one that's going to overwhelm any sort of negativity around the economy. And you're not just betting on the macro environment, or the macroeconomic environment. You're taking advantage of a company that's going to be small today, but much larger in the future. And then a couple of others that we like are Super Cheap Auto and Lavisa.
Okay, are there any that you're particularly steering clear of? And I suppose I wouldn't mind bringing in the idea of the online retailers, which, boomed, has come right back, where they sit into this story.
Yeah, well, so we've avoided companies that let me take a step back. When you're investing, you want to buy quality. You want to buy a business that's going to be bigger in the future than it is today. It's got to be a high-quality business with high-quality management, but you also want to buy it at a cheap price. So the ones that we're steering clear of are those that we don't think are as high quality. We don't know whether they're going to be bigger in the future or not. They might be more sensitive to the economy. So, for example, mature retailers, those mature retailers, a lot of them have benefited from the boom in renovations and additions and the boom in real estate because people have been fitting out new homes and fitting out new renovations. But that's done now. The cycle for those products is pretty long. You don't replace your fridge or your appliances very often. And so therefore those big mature retailers that are selling appliances, they're going to be more sensitive to slowdown in real estate, more sensitive to any sort of slowdown in the economy. So we'll avoid those, and we're also avoiding those that were really expensive and those prices weren't justified by the underlying fundamentals of the business.
Roger, thank you for talking to the Fast Five.
A pleasure.
That was Roger Montgomery, founder and Chief Investment Officer of Montgomery Investment Management. What do you reckon, Michael?
It's a fascinating sector, and it's interesting, isn't it? Because these are companies that people can kind of have something to do with almost every day, whereas
relate to.
You really don't have that much to do with some of the big miners and that kind of thing, do you?
Yeah.
And as always, you should get professional advice before making any investment decisions. Thank you very much, Sean.
Thank you, Michael.
That's it for today. Make sure you hit follow on the podcast. I'm Michael Thompson, and that was The Fast Five by Fear and Greed.